Funding a new business is a very important part of starting a business. And there are three major ways of funding a business: bootstrapping, debt funding, and equity funding. So bootstrapping, as it's listed there on the slide, is using as few resources as possible to start the business, or using others' resources to help offset some of the costs that you might encounter. During the recent recession, there was a lot of emphasis on bootstrapping because there was not a lot of capital in the market and banks were not lending. Debt funding requires that you pay back the funds and that you pay interest to use the funds that you're borrowing. Think about a loan as a form of debt. Equity is selling a portion of your company. When we talk about the different sources of funding, you need to consider a number of different things. The first thing to consider is the stage of business development. Are you at the seed stage, the startup stage, early stage growth, or are you an established company? You also have to think about the type of business and the potential growth and profitability, as well as the type of assets that you're looking to fund or to finance. Another thing to consider is the external financial environment. You have to look at the interest rates and their term structure. If the rates are high, there's a good chance you might not want to borrow as much money and look for some other sources of funding, such as selling a portion of your company. You should also consider the stock market performance, the health of financial institutions, the level of confidence in the economy, and the government's monetary and fiscal policy. The last thing listed there on that slide is your goals for the business. If your desire is to control the business from the startup until you someday exit it, there's a good chance that you'll want to fund your business through bootstrapping and debt. If you're willing to share a portion of the ownership of the company in order to grow the company to a good size, you might want to consider equity funding. Debt is borrowing money that you have to repay at a predetermined date in the future. Different forms of debt that are listed there on the slide include credit cards, personal loans, bank loans, lines of credit and revolving credit agreements, trade credit, accounts receivable loans, and factoring, as well as the use of finance companies. I'd like to draw your attention to the first bullet there, the credit cards. Now, what's the advantage of using a credit card to start a business or to grow the business? Well, they're relatively easy to get. Many of us have received in the mail credit card applications. But you think about it, the downside of a credit card is that if you don't pay it when the money is due, the interest rate is often very, very high. And so it can be very costly. But a lot of young entrepreneurs use credit cards to finance the startup of their business. As far as personal loans are concerned, you might want to borrow money from your friends or your family. And we'll talk a little bit more about bank loans in a minute. You also want to think about, is it a short-term loan, an intermediate loan, or a long-term loan? Current or short-term loans are 12 months or less. They're short-term, and they're often created by trade credit. So if you're buying inventory, for example, and you borrow from your bank to finance the purchase of the inventory that you're hopefully going to sell in the short term, that would be short-term credit. Intermediate is 1 to 10 years, and long-term is 10 years or more. And of course, you have to be an established, stable company to be able to borrow on a 10-year loan, using a 10-year loan. So let's think about the advantages and disadvantages of debt. First of all, the advantages are that you're borrowing money. You don't have to sell a portion of your company. And so you can control the entire company. The downside, the disadvantage, is that you have to pay interest on the money that you're borrowing. And interest expense can be difficult to pay when cash flow is short or limited. And oftentimes, debt requires collateral. Startups often struggle to have the collateral to secure the loan. The next one there is equity. And there are several forms of equity I want to draw your attention to. The first one is closely held stock. So if you start a business, you incorporate, and you own the stock, perhaps ask a friend or a family member to invest in the company, buy some stock. It's now called closely held stock. All of the owners are connected in some way. They know each other. Angels are another form of equity, and angels are investors who invest in typically startup companies, and I'll talk a little bit more about that in a few minutes. Venture capital, again, more on that later, and initial public offerings. The first time you sell your stock on a publicly traded market is an initial public offering. Just like debt funding, there are advantages and disadvantages of equity funding. First of all, the advantage includes there's no need to pledge any personal or corporate assets, no need to put up collateral against a loan. You don't have interest expense, so think about when cash flow is tight, you don't have to pay the interest expense. And you can tap into your investors' network and benefit from their expertise. Disadvantages, while you're selling a portion of your company, you really have to consider, is that okay with you? Do you feel comfortable having someone else or a group of people own a portion of your company? And there are many benefits to that. Again, you can tap into their network and you can benefit from their expertise, plus you can bring in more capital to grow the business. Equity capital, equity funding also can be risky for investors. Remember that debt funding is secured by collateral. Equity funding is an investment in the business. So if the business is not successful, the investors can lose their money. Think about the fact, however, that when you're a startup, equity capital may be the only way to raise the money that you need to start up and operate the business, because a startup is just too risky for a bank to lend to. Okay, so let's talk about bank loans a little bit. When you go to a bank and you ask them if you can borrow money for your business, some of the things you have to think about are, what do you plan to do with the money? How much money do you need? When do you need the money? How long will you need it? Remember the short-term, intermediate, and long-term. How will you repay the loan? You have to have cash flow to be able to pay the interest and then eventually pay back the principal of the loan. You also have to look at fixed versus variable interest. If the interest rate is low and you get a fixed interest rate, it's going to be low for the life of the loan. If it's variable, you run the risk of having an increase in your interest rate when the interest rates increase. Banks also use what they call the 5 C's of credit. Character, which has to do with integrity. Capacity, which is sufficient cash flow to pay off the debt. Capital, or your net worth. Collateral, the assets you have to secure the debt. And conditions. Conditions about the borrower as well as the overall economy. Recently, banks have become much more stringent in their lending, especially to small and startup businesses. And one of the 5 C's that in the recent past was not considered to be so important was character. Banks were really looking at capital, collateral, and so forth. With the recent downturn in the economy and now the recovery that we are experiencing, banks are paying very close attention to character. They want to make sure that even if the conditions deteriorate, the business starts failing, that the borrower has the integrity to commit to the loan and to pay it off. Okay, so let's go back to equity investment, equity funding. When it's too early for a bank to lend to you because you don't have collateral, you don't have cash flow, you're an unknown quantity, they don't know about your integrity, one of the things you really have to do is to think about, how are you going to get your money? Are you going to bootstrap, or are you going to sell a portion of your company? equity investment. There are 3 different private investors that I have listed on that slide: angels, venture capital, and corporate partners. The last bullet item is an initial public offering, IPO, and I mentioned earlier that's the first time that you would sell a company in the public market. Let's talk a little bit about the first private investor listed there, angels. So angels are individuals who invest between $5,000 and $500,000, with the typical being about $250,000. They're often successful entrepreneurs who have either exited their business or now have some money that they want to invest. They bring with them a lot of experience and expertise that they can give you in growing your business, starting up and growing your business. There are affiliated and there are unaffiliated angels. So affiliated angels are part of a group, a larger group. And in the greater Philadelphia region, we have a number of angel groups, including the Pennsylvania Private Investors Group, PPIG, LORE, the Loosely Organized Retired Executives, and then there's Golden Seeds, which has chapters locally, as well as the Keiretsu Forum, which just launched a chapter here in the greater Philadelphia region. And I'm happy to say that Westchester University is an educational partner of the Keiretsu Forum. PAN, the Pennsylvania Angels Network, is a group of, it is an organization that works with all of the different angel groups in the state of Pennsylvania. There's also a new organization, angel.co. If you go to their website, you'll see that it's a social network for angels and entrepreneurs looking for angel funding. Unaffiliated angels are those that work independent of an organization. They make their own decisions and are independent. As far as the typical recipient, angels generally invest in startups or early stage companies. They look to cash out or exit their investment in about 5 to 7 years. And they hope to generate a return on their investment of 25 to 50%. The next slide, venture capital, has to do with investors who pool their money into a fund and the fund invests in your business. The venture capitalists are the experts who oversee the fund. As I noted on the previous slide, angel investors, of course, want to exit and exit successfully. Venture capital funds and venture capitalists are investing solely with the exit in mind. They want to invest for less than 5 years, 5 years at the most, and they want to have a 10 times return in those 5 years. So they're really looking for a high return rate. The fund typically invests in about 10 startups or early stage companies, or whatever the venture capital fund focuses on. It might be a mezzanine fund, an intermediate fund. And of those 10 ventures, they are delighted if they succeed with one of them. If they can generate a 10 times return on their investment from one of the 10 investments, they typically are very happy with their performance. If you're interested in reading about venture capital a bit more, there's a nice article, and I have that reference at the end of the presentation PowerPoint slides. As far as, life cycle stage and industry expertise, venture capitalists focus on particular stages in the life cycle of a venture. So, for example, one fund might be focused on early stage, another might be focused on the growth stage, and another fund might be more focused on established businesses. They also focus on the in particular industries. And another benefit of venture capital is that they bring with them professional management skills, experts that they can bring onto the team, and also they take a board seat to help guide you and help you grow and succeed with the company. Let's see, that second bullet point there, they often will take preferred stock in the company, so they have a preferential right to the company, and that is a hybrid vehicle that combines a little bit of debt and equity, the properties of debt and equity. Again, if you're interested in venture capital, I can help you with that a little bit more, and take a look at those sources that are at the end of the PowerPoint slides. I do want to draw your attention to that last bullet point there, the PwC money tree, PricewaterhouseCoopers, and I pulled that up for you if you want to take a look at it really quickly. They give you some really nice statistics about venture capital. So they have things broken out. If you look at the fourth quarter of 2010, which is the most recent data that's available, you can see the money that's being invested in expansion stage businesses, early stage, a bit less, later stage, and then if you look at that bottom line there, you'll see that startup and seed stage companies are getting the least amount of VC funding. You can also look at the breakdown by industry. And you'll see there that software tops the list in terms of VC investment, energy, biotechnology, a close third. Well, I guess not really a close third, but it is the third there. Followed by media and entertainment, IT services, medical devices, all the way down to retailing and distribution. They're probably established companies that are getting that funding. And then you can look at by region. And you can see that Silicon Valley, no surprise, is getting a great deal of funding there, as well as the other major areas in the country. If you scroll down, you'll see Philadelphia Metro getting about $85 million of investment. And you can see there at the top that the average dollar per deal is about $6.5 million, 765 deals. And there is the link for you to take a look at it in more detail if you're interested. I talked about return on investment. You can see there that VCs, for startup businesses, the idea stage, they're looking for a very high return, 60%, 10 to 15 times increase on their initial investment. For first stage financing, new businesses, so the business is in operation, a little less return is expected. Second stage, less risky opportunity, so the return that they're expecting is lower. And then finally, an expansion stage, 25 to 40% return. Turnaround, 50%. I do want to draw your attention to that last line there. During the recession, no surprise, VCs were not investing in startups and early stage businesses the way they were in prior years. A lot of their money was being dedicated to turnarounds. What do VCs look for when they evaluate a business, potential investment? Well, the first thing they look for is the entrepreneur and the team. They're really looking for personality and experience. They want to be able to trust you and know that you're competent to take the idea that they're investing in, the business they're investing in, and turn it around, fix the problems, grow the business, and be able to handle the money that they invested in your company. They also look at the nature of the proposed business or the business that's in operation. And they take a look at some other characteristics. The market that you're targeting, the financial information that you're including in your business plan, the economic environment, and your proposed business strategy, and the potential for growth. Remember, they really want to generate a high return on their investment. So they're looking for a lot of growth. I mentioned that VCs are looking to exit the business. They're investing so that they can successfully exit and make a high return on their investment. One of the ways they can do that is by helping you sell the business to another company, or to take the company public. During the late 90s, early 2000, there was a big emphasis on initial public offerings. Successful entrepreneurs saw this as the gold stamp of approval of their business. They wanted to take it public. It would provide liquidity for their business. They could sell their stock. And it was a great way to provide credibility for the business. When Sarbanes-Oxley came along and there was a lot more regulation of publicly traded companies, the number of IPOs slowed down, and some public companies even sought to go private by delisting and removing themselves from the high regulation that a public company requires. Going public is a long and costly process. I've done a lot of research on initial public offering companies. It's very highly regulated, but it does provide a great opportunity to acquire capital to grow your business. And that is the primary reason that you would take a company public. In terms of what is a good candidate for an IPO, well, your projected growth in your market cap is in excess of $100 million in about 3 years, a little over 3 years. So we're looking for a lot of potential growth. If you're not going to grow the company to that level, you're probably not a good candidate for IPOs. There are some other vehicles to get your company into a public status, but that's beyond the scope of this presentation. You want to be able to deliver consistent double-digit growth in sales and earnings after you go public, and the investors are looking for businesses with high gross margins, meaning that they're going to be profitable in terms of operations. So one of the last things I want to draw your attention to has to do with the stage of a business, the business life cycle. And if you look at this graphic, you'll see on the y-axis the level of investment risk that the investor assumes. And on the x-axis, you'll look at the stage of the development of a company. So at the seed stage, you can imagine that the risk the investor bears is relatively high, very high, in fact. And this is probably the best time, or the best investors for you at this time is a group, what we call the 3 F's: the founder, the friends, and the family. You personally put money into the business, you go to your friends and ask them to invest, and of course you can talk to your family and ask them for funds. Sometimes it's called friends, family, and fools, but that's not the official term. And of course you understand why fools. You don't know if the company is going to succeed. At startup, another source of funding is business angels. We talked about that. A little less risky. You've moved beyond the seed stage. When you get to the early growth stage, that's a primary time to go after venture capital funding. During specific bubbles, you'll see VCs investing in seed stage companies, but for the most part, we're looking for early growth stage companies. You can also go to non-financial corporations when you're in the early growth to established stage. This would have to do with perhaps your suppliers asking to borrow from them, or you might be able to sell your accounts receivable or something like that to generate cash. Equity markets, we're talking about initial public offerings. And when you have reached the early growth stage and are in the established stage, this is the time when the risk is low that you can go to the bank and you can ask them to borrow money. And you now have collateral, you have a proven track record, and you're not as risky. What do you do at the seed stage or even before the seed stage when you're just exploring perhaps a technology? And you need to create a proof of concept to show that this device or this equipment or this gadget is going to work. Well, there are a couple of ways that you might be able to do that. If you can't get the money from your friends or your family, or you don't have money, let's say you're just graduating from college, I would recommend that you look at entering a business plan competition to try to win some prize money that you can use. Another way to try to get funding is to look for grants. Sometimes the state or the federal government has grant funds available. If you team up with a local university, sometimes you can get funding. So there are two ways to take a look at that. The next slide has a list of references. So if you do have some interest in some of the topics we talked about today, you can take a look at these references. And of course, I'm happy to answer questions. So if you do have a question at this point and you want to email me, please send those emails and I will address the questions. A couple people in the room, do you have any questions? Please.
For the VC funding, do you have to be a corporation to get that funding, or can you be any sector?
When I'm talking about equity, yes, you do have to be a corporation. So the question was, do you have to be incorporated in order to get venture capital funding? They're buying a portion of your business. They're buying a portion of the stock. They also want to make sure that you have the legitimacy that a corporation provides. And it's a select group of companies that do get venture capital funding. It's vital that you have a great business plan. We talked about that before, so that's another thing to consider. Good question. I think that's it. So if you do have questions going forward, please send me an email. I'll be happy to get back to you. Thank you.